Looking to plan a business event, but not sure where to start? With over 15 years of experience, Captivate Events is the expert in event planning and execution. Our dedicated team are specialists in business events, including gala dinners, exhibitions, conferences, seminars, overseas study tours, and more. Let us take the stress out of event planning whilst delivering an exceptional experience for both you and your guests. Visit www.captivateevents.com.au or call 02 8866 2440 and find out how we can captivate your audience.
This is a Momentum Media production.
The SMSF Adviser Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hello and welcome to the SMSF Adviser Show. I'm your host, Keith Ford, joined as always by my co-host, Aaron Dunn from Smarter SMSF. How are you, Aaron?
Very well, Keith. Yourself?
I'm doing well on this nice sunny day in Sydney. It's sun shining. It's very nice vibe. But we've got a lot to talk about. We've got a great guest today. We're being joined a little later by Peter Burgess, who's the CEO of the SMSF Association, to talk about mostly Division 296, but a little bit on the QAR and basically the lobbying process.
Yeah, it's fun and games, isn't it? You know, we've sort of spoken about it ad nauseum. There was a while, Keith, I remember, where we were kind of waiting, and we keep talking about it, and then we become law, and now we're at a point where we are now trying to get some insight into the negotiation, or the fun and games, we might call it, to trying to get the government to listen to some of the concerns that we've got within the industry. So, yeah, I'm really excited and looking forward to the discussion with Peter in today's SMSF Adviser Show. But before we kick that off, let's have a chat about what's making news.
Absolutely. And so the first big thing that has come down is something that a lot of advisors have been waiting on, which is the first draft legislation coming from the Quality of Advice Review. It's been quite a long time coming. I think it was December last year that the final report was actually given to the government, I believe. We got the response from the government in June of 2023, I believe. And we've finally now received some actual draft legislation. The big news out of it, statements of advice were not included. The safe harbor from the best interest duty was not included. Both of those were expected to be in this first tranche. And then the legal basis for superannuation trustees to pay a member's financial advice fees from their super account has been moved up from tranche 2 to tranche 1. But the idea generally of this first one is to cut red tape. It's got the recommendations that are about consolidating ongoing fee consent documents into a single document, a bit more flexibility in the way that financial services guides are provided. And that's the kind of headline news from the QAR. Have you had much of a chance to look through and get a general vibe on what's been happening?
Yeah, I think the reality is I think the minister made mention of this in the fact that these were about to be released, was whilst there were some notable absences, we might call it, they were not going to become a question of whether they were going to get included or not, but they will. But the idea or the process behind it is, why wait on trying to release some of these for the basis of trying to kind of tidy up some loose ends on the other elements? So I think even though there is a level of disappointment in the absence of some of the things in these, you could kind of call it tranche 1A, and then there'll be another tranche, maybe 1B.
It is a little bit like that, it seems.
It is, yeah. So from that point of view, if we take a glass half full approach, we're starting to see some progress. Kind of feels like pulling teeth with respect to, the process from when Michelle Levy was looking at these, and even the discussions from her final report, and then what the government's considered and obviously further consulted on. And so we're kind of been in these almost 6 month blocks. So you'd like to feel as though now that we've got 1A out, that 1B should follow fairly quickly and really build momentum into 2024 to, address the core of really what that report did. And I guess even to the extent of which the government has indicated that they would address each of those stages in terms of how the government has broken it down as well.
Yeah, absolutely. And, as you mentioned with the idea that the statement of advice, the safe harbor, the government's indicated that that is still something that is happening. It's not that they're scrapped or anything along those lines or being held off for a particularly long period. It definitely was my read of their statements, and what the minister has been saying is essentially that it would have held up this first draft legislation even longer. It obviously has been, for many people too long already, but it would have held it back even further, which, I guess if you look at it from that perspective, it might be positive that we've at least got something.
Yes. Something is better than nothing. Isn't that what you normally say? So
I think usually, yeah.
Yeah.
We might leave the QAR there. If any of our listeners would like to hear a bit more information on the QAR, there will be an IFA show podcast breaking it down, pretty much the entire podcast all about the QAR. So anyone who wants to hear more, they can have a listen to that. We'll move along to our next topic. There was, I think, last week, the SMSF Association and a couple of the other accounting bodies, they were pretty against the gnarly amendments, I think you could say, and wanted the government to essentially rethink some of these rules that are being put in place. Can you give us a little bit of an overview there, Aaron?
Yeah, so we have a situation now, of course, with the gnarly and gnarly amendments where they are before Parliament, and we are at the point where it is before the Senate. And that bill got referred to a Senate committee for further review and ultimately provided an opportunity for further submissions, which we have seen the joint accounting bodies and the SMSF Association and so forth make further submissions. Interestingly, this week, we have actually seen some of those bodies actually appear before that Senate committee and really refer to the submissions that they've made. And those relate to things like the fact that, does this problem actually still really exist? You've made it now deliberately an SMSF issue and not a broader industry issue. APRA funds have been excluded from it. So therefore, are we trying to fix a problem that actually doesn't exist? So maybe do we go back to where we were? And even if there is an issue, well, can we actually put it within the arm's length requirements, for example, in the SIS rules rather than the tax rules? So again, let's try and get some uniformity as to it applying like the Div 296 rules rather than sort of carving out some differences in between. And Keith is smiling there because he knows, and as many of you that listen will know, that it's rubbed me out the wrong way for probably many months now. But so there's some of the things ultimately that we've seen, and hopefully through this process of consultation at a Treasury level, or at least raising these issues, we may see Treasury contemplate this further. And therefore, maybe, just maybe, these measures might not proceed as they currently are.
I think equitable treatment of all super funds could be the mantra for the show at this point.
Yeah, correct.
You got to keep the rules the same for everyone, ideally. Yeah, it'd be good if we could get that. Who knows? Who knows? Yeah. You got to. Yeah, but
I'll tell you, it's quite interesting. I digress for a minute, but Jeremy Cooper, when he did the Cooper Review back in 2009-10, there was some guiding principles that he spoke about there. And as part of that journey, it did identify that, yes, you want some uniformity, but SMSFs actually do have some nuances amongst them that would require their own rules, collectibles or whatever it might be. But, I think if you looked at that as a concept, these sort of things into the tax rules, I think would be beyond the scope of what might have been intended at that government review. But, I think we have to readily acknowledge that there are times where SMSFs might need to have their own set of rules, just not in respect to the gnarly from an income tax perspective. And we could probably keep talking for a long, long time.
And just put a quarter in and you can roll.
Yeah, correct.
Something that it's not generally, from what I've seen of the reaction to this, has not been viewed as particularly positive, but it's certainly an improvement on what the situation was. And that was that the ASIC levy has actually been reduced by $400 per advisor. Now, many people might hear advisors are being, save $400 here and think that's unequivocally good. Generally, I don't think that's been the reception. Essentially, the idea being, well, it's too high no matter what. It shouldn't exist. We don't want to be paying this. Even with the $400 off, that's just a a dent in the price, and we'd much prefer if it didn't happen. Is that kind of the vibe you've gotten?
Yeah, absolutely. If you think about the proportionate change that happened and the fact that it's skyrocketed as we've seen a number of advisors exit and that sort of stuff over the past few years as well, $400 doesn't really fix the root cause is probably the best way that I would frame it.
I think that's definitely kind of the feeling that many people have got. It's like, all right, yes, you've reduced it, but if the way that you've gotten to it to begin with is a problem, then it's still a problem. Even if you've given us a bit of a discount. Yeah,
absolutely. So yeah, whilst they might be celebrating this $500 discount that's being provided to advisors in Canberra, they might not necessarily be doing it out in the real world where they're obviously seeing the ongoing cost of advice being more and more and more. And therefore, we need the elements of the QAR to actually start to be the real differentiator in the cost of obtaining advice.
Absolutely. So, if you've got these measures that are in place or going to be in place through the QAR legislation, essentially to increase the availability, the accessibility of advice, make it a bit cheaper to provide by cutting some of the red tape. That's the whole idea of the first stream. And I guess, 1B as we're calling it, is to reduce that red tape so that you can reduce the cost and then advisors can provide advice for a little bit cheaper. When you're being hit with the ASIC levy that has jumped quite considerably year on year due to the ending of the freeze, it's kind of going at cross purposes.
Yeah, absolutely.
Well, we might leave it there for the opening section and take a quick break. And as we mentioned at the top, we'll come back with an interview with Peter Burgess, who I'm sure everyone will want to stick around and hear from. Welcome back. We're joined now by Peter Burgess, who is, as every one of our listeners will know, is the Chief Executive Officer of the SMSF Association. How are you, Peter?
I'm great. Thank you very much. Thank you for having me.
Not a problem. We are also, it has been a little while since my co-host Aaron has been in one of the interview portions of this podcast with us, but Aaron is still sticking around.
Very good. Yeah, we're back to the technical boffins talking again. So it's nice.
I can probably just leave and let you two go through.
Well, Pete, maybe let's start off with the one that we know is going to have a very sizable impact on the SMSF industry. And it now has a name. So Division 296 tax.
Right.
Not to be confused with its friend just down the road at Division 293. But equally, we have an imposed tax on an individual that potentially has the release from the fund. We were jokingly saying, I guess, before this, that I think since you were appointed as CEO, this has pretty much landed on your desk from day one, if I wasn't mistaken, as CEO, just about. And it's probably been the bane of your existence since.
Yeah, that's right, Aaron. It's been pretty intense, I've got to say. I think I was in the seat one day. I think it was released late February, the consultation paper, or with the actual announcement around this $3 million cap. And so it's been pretty full on since stepping into the role officially on the 1st of March this year.
Yeah. So quite clearly, this is going to have a sizable impact. The government talks about it only impacting a small percentage, but that small percentage is a reasonable percentage within the SMSF sector. And the SMSFA is naturally being quite vocal on the concerns and have made multiple submissions around these. And in its current form, it kind of feels like things have fallen on deaf ears. So maybe a little bit about the journey that the SMSF Association has done in terms of flagging issues, and then maybe where we're at and what some of those primary concerns have been, and then maybe some of the nuances as well.
Yeah, look, absolutely. So, the association right from the outset hasn't supported this tax. In our view, this is very much a tax that is designed to fix a problem that will fix itself in the not too distant future. It is designed to address very large balances. Now, we have seen some recent research which suggests that almost 80% of people impacted by this tax are 65 and over, and a fair majority of those are over 75. So, clearly this is a problem, as I said, that will fix itself in the not too distant future. We're worried that, the last thing we need right now is the introduction of a new cap. and a new threshold. The system is already complicated enough, and we're about to make it even more complex just to fix a problem that will go away, in the not too distant future. So, that's been our position since day one. We do acknowledge, though, that it is very unlikely that the government is going to change their mind, and we are expecting legislation to be introduced into the Parliament very soon in early December. So it's looking like they're going to push on with the proposed approach to calculating earnings. So our focus right now is on making sure this tax works as fairly and equitably for all superannuation members. In our view, the only way you can introduce a tax like this, a tax on earnings, superannuation fund earnings, which is payable by the individual, is to ensure the tax is levied on taxable income. And of course, what's being proposed here is that the tax will not just be calculated on taxable income, but also unrealised capital gains as well. And as soon as you bring in unrealised capital gains into the calculation, you get some very bizarre and unintended consequences. And, we've seen a fair few of those that our members have notified us of. And, that's our concern. This is very unconventional, very unusual way of calculating earnings. So what we're saying is, look, if we have to have this tax, let's make sure that it is just based on taxable earnings and not anything more than that. It's been made clear to us that the option of just taxing taxable income, which is what our preferred position is, we know that many self-managed super funds would be able to report the actual taxable income attributed to each member to the ATO. It's been made very clear to us that whilst SMSFs can do that, large funds can't. So whilst they identify earnings, taxable earnings at the fund level, they don't, not all large funds, some do, but a lot of these large funds don't identify taxable income down at the member level. So unfortunately, there isn't support for the view, for our position that this tax should be based on actual taxable earnings, simply because many of the large funds can't identify that income. So that's why we've got this formula approach that Treasury and the government is very keen on, and it's why we're looking, being taxed on unrealised capital gains. So what some of the discussions we've been having in more recent times, and we have spent quite a bit of time in Canberra over the last few weeks, we've been having some discussions with the lower house TILs as well as the Senate crossbench. And, I've got to say there is quite a bit of concern about the fact that this new tax will tax unrealised capital gains. I think there is, an acceptance from the crossbench that that's not good policy. And we're working with them to try and find an alternative calculation of earnings, the one that doesn't involve funds reporting actual taxable earnings, because we know that's not going to be accepted by the large funds and others outside the SMSF sector. So, our focus has really moved to, a deeming rate. Yes, look, there are winners and losers with deeming, but by process of elimination, we can't see any other way of dealing with this issue. So we've been tossing around a deeming rate. Now, our support for a deeming rate approach would only be on the basis that it's pitched at the official cash rate. We don't think a rate any more than that would work. And in fact, you're probably better off with Treasury's proposed approach. But, according to our initial calculations, if you have a deeming rate that is down at the 90-day bank bill rate, then in the main, clients would pay less tax under a deeming rate approach compared to the Treasury's proposed approach. And deeming would have the other added benefits of being much simpler to apply. So we wouldn't have to worry about, carrying forward negative losses and those type of things. And also it would be much more predictable in terms of the outcomes. And we think this is a big problem with the government's proposed approach, because they are linking the tax to performance in investment markets. The liability could be very different from one year to the next. So, how do you manage liquidity when you don't know, what it's going to be from one year to the next? The end result will be that clients will end up holding a lot more cash than they absolutely have to, which means, and that'll have a long-term impact on their performance. So, that's why we think deeming has a few advantages over that. And so that's what we've been saying to the crossbench and the lower house TILs, that the only way that we can see you can deal with this is to move to something like a deeming rate.
Or you end up in a situation where you have a different set of rules for one and a different set of rules for the other, which quite clearly the government were not endeared with that. Yet on the Nali perspective, we have actually had something like that. So it's kind of, like, I know Keith has heard me venting probably just about every week on this show with those sorts of things. But, the reality is that, you know, a 2-week consultation that we've seen recently would definitely suggest that they've probably put the queue in the rack and are kind of marching forward.
Yeah, look, you're spot on. It is frustrating that, you know, it seems to be important that we have, you know, the same approach for all funds when we're talking about the $3 million cap, but it doesn't seem to be important when we're talking about NALI. So, you know, that has been a source of frustration. I agree with you on that. And that's one of the reasons for the $3 million cap, that they're not supporting the using actual taxable earnings and basing tax on that, because of those, you know, the large funds that aren't able to report that and are, you know, to identify those amounts. So for them, that's not possible. Hence, they're using this formula approach at the moment is their preferred approach. They seem to be wedded to that, and that's the approach that we expect when we see legislation introduced into Parliament in the near future. We expect it will be on that basis.
You mentioned the predictability, and obviously you were looking at it from the perspective of the member or the trustee, the predictability on that side. Having the predictability on the government side for when they're looking at things like budgetary, when they're doing their budgets and everything, you would think that the predictability on that side would also be a benefit for them.
Well, that's right. So to come up with their 4-year forecast, I assume they've had to make some assumption as to how investment markets are going to perform, you know, into the future, because this tax is linked to the performance of investment markets. And you're right. Using something like a deeming rate would be, we think, more predictable year on year in terms of what their revenue collection is likely to be.
And it's not as if that sort of approach isn't embedded in legislation at the moment anyway. I mean, we have that sort of notional approach with excess non-concessional as an example. So it's not as if it's it's not new, like we're seeing this sort of new concept of taxing unrealised gains in that function of total superannuation balance.
Yeah, exactly. You know, we're used to seeing deeming and used in other areas of the superannuation laws. But look, there's no doubt that, well, I think when people first hear of deeming, they say, well, you know, we're probably going to be better off under the Treasury approach. At least the Treasury approach adjusts for negative earnings.
Yep.
And it's true, because deeming doesn't do that. You're deemed to have earned a certain amount of earnings, taxable earnings, irrespective of what you've actually earned. But, you know, our analysis tells us, looking back over the last decade of superannuation fund returns, and there have been a few negative years over that last decade, that if you did use a deeming rate down at that 90-day bank bill rate, and that's really important, that's our support for this type of approach is very much predicated on the rate being down at that 90-day bank bill rate. It has to be a proxy for taxable earnings, and we think that's, you know, probably an appropriate proxy for taxable earnings.
Yep.
At that rate, you know, most members would have paid less Division 296 tax under a deeming approach rather than the Treasury formula they've got on at the moment. So it all depends on the rate. And as we're saying, it must be a close proxy for taxable income, and we think something like the official cash rate is where it should be.
And your research, which I think formed a really important part of this process, you know, identified there are going to be some, call them trouble spots, I guess, in terms of liquidity. I know quite often it's been referenced around farmland within SMSFs, and even, you know, sort of startup ventures where, you know, they might be looking at cancer cures and that sort of stuff. And you might see, you know, some research come out and the share price has gone from A to B and it's pushed someone over the 3 mil, and yet that trial treatment has been unsuccessful and it pushes it back down. These are all things ultimately that, without the body of evidence behind us about what the real impacts will be, we're not really going to know. And I guess that's some of the advantage of the industry that we have, that we can actually use so much real and live data now to be able to push this back. Now, to what extent the government takes that on board, who knows? But it is a real advantage for us in the industry now to have such depth in the information that we have to be able to provide research and insights back to government to ultimately try and help make better decisions.
Yeah, look, you're right, Aaron. And one of the advantages of the self-managed super fund sector is a lot of the data sort of lies with three software providers, if you like. And so we've been able to extract data from those providers and provide that to the University of Adelaide. Over 700,000 SMSF members were included in that data sample. So it's well over 50% of the entire population. So What we did ask the university to do was to model this tax, assuming it had been introduced in the 2021 and 2022 income years. And what we were interested to know is how many funds would not have had the required liquidity to be able to pay the Division 296 tax. And, they found around 13% of funds would not have had enough cash in their fund. Of course, they couldn't make any comment in relation to whether they had sufficient cash outside the fund, but looking at their cash balance in the fund, they wouldn't have enough cash to be able to pay that tax. And, this is what's concerned us from day one. If you're using a calculation methodology of earnings that picks up unrealised capital gains, it means that you're assuming these individuals have some cash reserves in order to be able to pay that tax, because you're taxing them on amounts that they haven't received and may never receive. And there's good reason why countries around the world, including Australia, don't tax unrealised gains. It's because it can cause liquidity, financial problems for individuals. And that's exactly how we see it playing out in the SMSF sector. So, and hence the reason that, we're trying to find a different way of calculating earnings. If we have to have this tax, if it is going to be based on earnings, let's make sure that the earnings for calculation is based on actual taxable earnings as closely as we can get it. So that's what we're striving to achieve at the moment.
Yeah. And you mentioned, Aaron's mentioned, we've looked at the falling on deaf ears idea, and there's obviously been quite a few stages of consultation already. From the very original outset to the point that we're at now, not a whole lot has changed. Do we have much expectation that there will be change in the next, which will be the proper legislation?
Yeah, look, we do expect when the legislation is introduced into Parliament early next month that it probably will mirror the draft legislation. So we're not expecting Treasury to make changes to that calculation of earnings that I keep talking about.
They might tinker around the edges, Pete, I guess, is, through this period of consultation, the exposure draft, there's some technical anomalies or something, such as if you die on the 30th of June, for example, you will be subject, but maybe on the other 364 or 65 days, you might not. Maybe those sort of things.
Yeah, look, I think you're right there, Aaron. There were a few technicalities that I think they need to tidy up on, and that's one of them, which we pointed out in our submission. So you will see those, but you're not going to see significant changes, I don't think, to what we saw in the draft legislation. I think the debate for this will take off in earnest in February next year. What we're going to see is the legislation introduced into Parliament in early December, but the regulations supporting this legislation will not be finalised at that time. They may be released for consultation, but they won't be finalised. And there's a bit of detail in those regulations, particularly in relation to defined benefit interests and how this tax will apply to those members. So it'll be very difficult for the Senate, you would think, to be able to vote on this legislation without those regulations being finalised. So I suspect we're going to see this legislation introduced, but stay in the Parliament over Christmas, and the debate around this will commence in earnest, I suspect, in February. We remain, optimistic that the Senate crossbench will hold up this legislation. As I said, the ones that we've spoken to, the members of the crossbench that we've spoken to, do have concerns around the taxing of unrealised capital gains. We expect at the very least this bill will get referred to a Senate Economics Committee for an inquiry, and that will
becoming good at those, Pete, too, aren't you? They won yesterday as well on the gnarly provisions as well.
Yeah, so I think we will see another inquiry on this particular bill. So that'll give us another opportunity, to put our views forward in terms of the fact that we think the way this tax is going to be applied is very unfair and unequitable. We're also pushing for this tax to be indexed as well. We think that's a common sense measure and can actually be quite easily accommodated within the draft legislation.
Well, Keith, we could probably keep talking to him forever, but I don't know whether there was anything else we wanted to sort of touch on, given that we have been probably well over time for what would be our normal SMSF Adviser Show. But Pete being here, we kind of want to make the most of it whilst we can.
We do. We might just quickly move to the most recent news happening in the advice space, which is obviously the broader advice, not specifically SMSFs, but also, of course, including SMSF advisors, which is the first draft legislation of the Quality of Advice Review has been open for consultation. This one's got a slightly longer consultation period than the Div 296. It's 23 days. as opposed to, I think it was 15 for Div 296. So we've got until December 6th to hear submissions for the first draft legislation on the quality of advice review. The big thing in there was that the recommendation to remove the safe harbor from the best interest duty was not included, which was slated to be in the first tranche. And the one that's really gotten the most attention, for good reason, is that the streamlining of the SOA system has also not been included. And then there was also a little bump up. One of the recommendations from Tranche 2 has been moved into Tranche 1. I think that's recommendation 7, which was around clarifying the rules for super funds being able to charge for advice. Broadly speaking, on this first lot of draft legislation, Peter, what were your thoughts when you saw what was in it?
Yeah, look, I think this is certainly the first step in the path to reducing red tape and reducing compliance costs for advisors. So, we certainly welcome that. We were disappointed that some of the other items that you mentioned around the safe harbour changes, and also there's the statement of advice changes that is going to be pushed into the next phase. So we're going to have to wait a little bit longer for those particular reforms, and they're the ones that certainly in our view will make a very big difference to the advisors and the cost of giving advice. So we were disappointed that we're going to have to wait a bit longer for those, but it is the first step, and as I said, we welcome that. The fee consents, the streamlining of fee consents, we think is an important one, and that will make a material difference, we believe, for advisors. But really that statement of advice one and the safe harbour parameters was the one that I think we were all waiting for, and a little disappointed that we're going to have to wait a bit longer.
It's definitely been a common refrain, has been that, look, it's good that this is happening. Yeah. It would have been great if the SOAs and the safe harbour were included. And from what we've heard from the minister, there was a media briefing on Monday that some media were able to talk to the minister. And from that, the idea, it was still definitely coming. I think the phrase, it's a when, not if, was mentioned. And so it is certainly something that the government still has on its agenda, but it has been pushed back a little compared to what we thought. Yeah,
well, that's good to hear. We weren't at that media conference, but it's good to hear that all indications are that it's still very much on the agenda, and we certainly hope it is. So we look forward to seeing that hopefully early next year.
Yeah, fingers crossed, I guess.
I was just going to say, Pete, from that point of view, it sounds like the SMSF Association National Conference is going to be pretty loaded.
Yes, we won't be short of things to talk about, for sure. So we're really looking forward to it. There is lots to talk about. Lots of technical sessions, as you would expect, on the $3 million cap, but there's been quite a bit, a lot of other things happening in the world of SMSF. So it's going to be a jam-packed agenda, I can promise you.
Very good. Well, thank you once again for you making the time. I know it's a very busy schedule for you, not only with your trips to Canberra, but everything else in between, including the upcoming national conference. So from Keith and myself, thanks again for joining us for today's edition of the SMSF Adviser Show.
Pleasure.
We'll take another quick break and then we'll be back to wrap up the week. All right, well, we're back now again, just myself and Aaron, to give a little bit of a wrap up of the week. Aaron, obviously a lot in there from Peter Burgess that was very interesting. Obviously, the deeming rate came up quite a bit, which the specifics around the deeming rate and how they would couch their support for that measure, I thought was quite interesting. That, yes, the SMSA's position is that the deeming rate is probably the better way, the lesser of the evils, I suppose.
Evils, yeah.
And that's the best way to go, but with the very strong caveat that it has to be somewhere near the cash rate.
Yeah, I think that's right. I mean, the reality of all this is it's almost the definition of insanity, isn't it? You can only go back and say the same thing so many times if the government's actually not going to listen to this. So you kind of need to come up with something that might pique their interest and keep it simple and satisfy, what the government's trying to do. Whether that deeming rate does or doesn't satisfy what they need to do, well, only time will tell. I think we've probably got all the inferences we needed as part of that 2-week consultation period. I think the approach that the SMSF Association and others are now doing sounds like the right one, in terms of it now just becomes a bit of, or not a bit, a lot of lobbying and working behind the scenes, talking to the crossbench senators and trying to kind of round up as much support to these issues as well, and get it to a point where there may be a Senate inquiry at least into the topics that'll then get them another seat at the table to try and flag these issues and maybe, just maybe, get some change. It might not be exactly what we want, but it might actually move the needle just a little bit as well.
Yeah, that idea of, as with anything in politics, there are compromises and people trying to just get it to work the way they would like, but everyone's got a different position and sometimes you have to meet somewhere in the middle. What's the phrase about the negotiation? If both people are unhappy, then it's a good negotiation.
Yeah, that's right. Yeah, correct.
Which very well may be what happens. Everyone will end up unhappy with where the government finally lands.
Yeah, absolutely. And I think the SMSF Association has really tried its best in flagging many of these issues. Again, the difference between what we might see, interesting, Peter suggested that we might see the measures introduced into Parliament maybe in December. So whether even some of the identified issues in the 2-week consultation, whether some of those things get addressed, we'll just need to wait and see. And then again, the fun starts once we start to see some of the regulations as well. So yeah, plenty of water to go under the bridge, which makes 2024 quite interesting when you overlap that with QAR, Objective of Super, NALI, all those wonderful things that are impacting the SMSF and more broader superannuation sector.
Absolutely. I'm sure everyone listening is really hanging out for a bit of a break from all the changes and everything going on.
Yeah, well, it's the old adage, is that the only constant is change. So... Well, Keith, as is always the way, if anyone has any suggestions on topics and speakers and the like, how can they get in contact with us?
Of course, they can get to us at editor@smsfadvisoronline.com.au and send through all of your suggestions.
Excellent. Well, thank you once again for joining us for this week's edition of the SMSF Adviser Show. We look forward to you joining us for our next edition. Take care and bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Feeling trapped by rising interest payments? Escape from mortgage prison with expert refinancing assistance from Finny. We have helped hundreds of borrowers break free from higher loan repayments by finding a more suitable loan. Our expert team can quickly assess your situation, and if there's a better lender available, we'll find it fast. Don't delay. Call today. Speak to a Finny mortgage specialist on 02 8866 2444 or visit our website at www.finny.com.au.